It's our Forex blog for August 15th, 2014. I'm spending pretty much all my time working on our Forex signals. Let me just showcase how they did today. Again, the key to trading is small losses, big wins. Starting today off, this is the first trade. This is the risk. This is how much you made. Then we bought the low here at this little double bottom. That's your risk. This is how much you made. And when you're making 2 to 4 times more on some of your winning trades than you are your losers, and you have more wins than losses so far, 100%, that win is bigger than the risk. And we went long here, got 1.5 times profit. This is the first loss. This is what your risk was. However, the trade did go our way a little bit, so we yanked the stop up and we actually lost this amount. So we actually lost, in this one instance where we lost, half of what the initial risk is. And that's one of the mathematical benefits of trading, is because if you have intelligent stops, you're not always going to lose what your risk is, and oftentimes you're going to make many multiples of your risk when you're right. So this is about a 2 times bigger profit than what the risk is. We went short here, made money, went long here, pretty much broke even. So one very tiny loss with wins significantly bigger than the losses. And if you add up these wins, by the way, you will see that it's more of a distance than the entire day's range. The low to high is far smaller than the profit of all the winning trades. This first one was like this, then the second one was like that, and then we had a tiny one. Half the trades during the day equal the entire day's range, and you have some of these other trades left over. It was an exceptionally good day, but you made about 2 times what the travel distance of the high and low is. Now here's a currency that didn't do much. It was kind of choppy, but it's good to showcase it because on days where the market's really not moving that much, the way our bar patterns are set up, typically there has to be some level of volatility or a breakout. Obviously the breakouts can all fail. Here you have a small loss. You went, this is your risk, and you pretty much broke even on that trade. This is your risk, and you made a tiny amount on this trade. So you can see you lost maybe 2 times out of 3, but this gets rid of this loss and some of the rest, and you only lost a tiny amount all day, less than 10 pips on a currency that's kind of choppy. If you traded multiple currencies, obviously you got that loss back in the euro dollar. Here's the euro yen. It did exceptionally well. The first move up, it was too strong to sell, so we're looking to buy a pullback. We get long, and you can see again 2.5 times bigger win than risk. You get long here, another nice win, and again it was too strong to sell. We wait to buy a pullback, and unfortunately this trade didn't work, so we have a very tiny loss. And then we have a breakout here of the previous day's high that generated 2 times more or 3 times more profit than what the risk is. So you got that loss back plus more on this trade here. Again, small win, big win, big win. And most people aren't going to take trades going into the close on Friday, but if you did, you probably lost 4 pips on that trade. And here's the pound yen. Those are the 4 pairs that most people trade. Let's scroll back to the beginning of the day. Really wasn't any trades. Again, we have a very small profit here, very small, nice profit here, a loss. You get that loss back on this one plus a little bit. And personally, I would have taken this little, slightly upward trending double bottom here at the extreme low. It's a good risk reward type of trade where you can get in with a very small risk, and as you can see, this generated significantly bigger profits than what the risk is. So if you don't know how to trade, most people aren't going to learn hundreds and hundreds of different patterns and be able to spot them on 12 currency charts at the same time in real time, especially since different ones use different indicators with different settings. There's over 75 different indicators with various settings on it. You're not going to be able to process all of that with one currency, let alone 12. But these are our currency indexes, which if you want to manually trade, I would suggest using our Forex signals in combination. But this makes trading quite easier because you can see what the currencies are doing. The euro is in a downtrend and exploded up, pulled back down. It's a little bit more than a 62% Fibonacci pullback, but it finds support at the hourly right here. And when a currency makes a big move, pulls back and kind of is in a nice little wedge pattern, when it breaks out right there, it's likely to continue on the direction up. So you have a very high probability of the euro going up right here. Well, the dollar was trending up, but it was below the hourly moving average most of the day. Today it rallied down, tried to go higher, couldn't take out the highs. It's underneath its hourly moving average, underneath the 15-minute moving average, underneath yesterday's most actively traded price in yellow. It's likely to go down. So at 7 o'clock, you want to look for a sell in the euro dollar. I'm sorry, not a sell, a buy. Euro is likely to go up. The dollar is likely to go down. So it's pretty much right here at that bar. The market's kind of going sideways a little bit for the last 20 minutes. The euro is likely to go up. The dollar is likely to go down. We would have already been in this trade earlier at a much better point at the double bottom right here. But if you bought that breakout, you can still get in that trade. And again, strong euro, weak dollar, you buy the pullback right here. You're watching the chart for a buy, and it pops up with one right here with a higher high than this. Pullback, 50% fib level. Again, 1.5 times more profit than what your risk is. By using the currency indexes and having an idea of what is likely to happen, you can see the yen here is weak. It's underneath its hourly, it's underneath the previous day's low. That's why you want to be finding a currency like the euro and at least earlier in the day, up until about 5, when this thing's clearly going down, you want to be looking for buys. So if you were watching the chart, you might have actually even bought this little breakout right here. It makes a higher high than the previous swing high. You buy this pullback right here, and again, it's all about small losses, bigger wins. Get this nice 2 or 3 times bigger profit. Buy this trade right here. And you can continue to look for buys until the yen starts to show some strength or the euro loses weakness. You can see it went down to the lower containment bands, and typically that's where the currencies as a whole will reverse. So you have an extreme likely reversal. Our perfect oscillator is showing it's likely to reverse back up. The euro's at the upper level, and keep in mind that the euro's weekly and monthly trend are still down. So it's not likely to power through the upper bands when the longer term trend is down. If the longer term trend was up, it's much riskier selling the upper bands. When the longer term trend is down, it's actually less risky to sell the upper bands than it is to buy up there at this extreme. It's much more likely to reverse. Now, the only thing bad about the yen is the weekly trend was down, the monthly trend was up. So, but it is at a likely reversal. So you got to be aware that the euro yen is likely, around 9 o'clock to be going down. So here's 9 o'clock on the chart. You're up at an extreme. If you see this little sideways rectangle right here and you sell the low with your stop above the high, you can see it went down a little bit, comes back up, you move your stop down, you're pretty much near break even, and then it falls. And you can ignore buy patterns if you see the currency index is exploding in your way. You just hang on to this trade. And then this is a beautiful little two-wave counter trend. It's actually a counter trend move up. The trend is down. You get short right here. And any two-wave patterns, against the short-term trend, where the trend is likely to resume, very high probability. And that's why these kind of trades generate very nice profits when you see them. I think there was another one in the pound yen today too. I look for these kind of patterns and code them up when I see them because they're such high probability. You gotta, people that are trying to buy the bottoms, you gotta let them kind of exhaust all the buying, and then the downtrend is much more likely to come into play. As you can see, even though it missed the remaining amount of this trade here, it still generated 1.5 times more profit than what the risk is.